Welcome to Retirement Solutions, the podcast. We are so excited about today's show, and today is all about the hidden retirement costs that could derail your plans. Because here's the reality. Most of you, do you know your expenses will be in retirement? Do you understand how sticky inflation can be to you in your retirement years? Do you understand the increasing longevity rates or the skyrocketing cost of healthcare that goes along with that longevity? Are you thinking through the likelihood of higher future taxes? In other words, your expenses could be a lot higher than you realize, and these expenses could put you at a much greater risk to run out of money in your retirement years. So, today is all about talking through four retirement expenses that are so easy to ignore but could totally derail your plans. Why taxes, inflation, healthcare, and longevity put your savings at a huge risk, even in fact, a lot more risk than you realize. Most importantly, though, we want to give you some straightforward steps that can help you to protect yourself and your family right now. And Ryan, we love talking about income as it relates to somebody's retirement plan, because really that's what the B.O.S. retirement blueprint is. B.O.S. stands for Build the Optimal System of Security. And what we're talking about with these pitfalls, as well as the solutions to these pitfalls, really all boil down to, first off, do you know what your expenses are, which relate to what your monthly income looks like, right?
Yes. And Tyson, when you look at this, I mean, if we identify these big areas of taxes, inflation, healthcare, and costs, longevity costs of just living longer, I think the number one thing that we hear over and over again, which is not correct for most of the families that we work with, is most people assume their taxes are going to go down in retirement.
Yeah, this is huge.
It's just not true for a lot of hardworking Americans. And when you add those IRA and 401k withdrawals, you add in Social Security, you add in other investment income that you have from other sources, could be an annuity outside of your IRA or 401k, it could be some rental properties. This can push you into a higher tax bracket than what you're planning on. And I think what happens is retirees also, they lose many of the big deductions that they had. Think about it. The kids are grown and out of the house. Your mortgage is paid off, so you no longer have mortgage interest that's deductible. And, most end up with a higher standard deduction, but that standard deduction is really not going to move the needle when it comes to taxes. And, tax expert Ed Slott says the income is higher and the deductions tend to be lower, so they're in a higher tax bracket. I mean, Ed Slott, Wall Street Journal calls him America's IRA expert. This is something that I call the new rules of retirement. The old rules are you just maxed out your 401k, you had a company pension, and you just had a little bit of savings in the bank and you lived off of that, and that's kind of what you could do. Now the pensions are gone, and the vast majority, we talked about in our last podcast, 93% of the families that we meet for the first time, 93% of all of their retirement savings is in a traditional IRA or 401k. So these are some massive, massive numbers. And Tyson, when we look at taxes, where are taxes right now in the big scheme of things when it comes to the overall national tax picture?
Well, this is what's crazy is so many people walk through our doors in any of our offices and they'll say something like this: man, I feel like taxes take such a huge bite out of everything that I do. How do I save money on taxes? And what they don't realize is that taxes are literally at a 40-year low, but our national debt is definitely skyrocketing. In fact, if the government keeps spending money at the rate that they are, the national debt is set to top $50 trillion, 50 trillion with a T, by 2034.
Oh my gosh.
And so as a result, Congress has got to consider things to take more money out of your pocket through raising taxes to cover the deficit. And what that ultimately does is that puts your own savings, your own money that you've worked so hard at risk. Because let's say the interest or the tax rates even go up by 10% over your retirement life. Well, that's a lot of money that ends up flowing out of your pocket and into the government's pocket. And nobody wants to not pay anything to Uncle Sam. We all have to pay our own way in the world, right? We have to make sure that there's good schools and good roads. But at the same time, you have the ability right now, more than any other time in your life, as you get closer to retirement or the first couple of years in retirement, to really flip the equation and for you to control and Washington proof what your taxes, what your savings, what your outflows look like. And so we want to talk today a little bit more about looking for what we call stealth tax hikes.
Wait a second. Do you remember when the stealth bomber came out?
I do. It was like the newest technology, right?
In high school, we had this class. It was like teaching about careers in the future.
You know you're aging yourself when you say that that was in high school, right?
Well, I don't know exactly when we were in high school if the stealth bomber came out, but they had a picture. It was a military ad to recruit and join the military, and it had this picture of the stealth bomber. And I can still sit there and it's in the middle of the Cold War, and you're thinking we're gonna we're gonna win this war with the stealth bomber. You just had these visions. Top Gun had come out, and you're just like, okay, this is gonna be awesome. No one's gonna take us. And so we were talking about stealth bombers because Ed Slott says that IRAs are really an IOU to Uncle Sam, and that IRAs are the IRS's version of weapons of mass destruction. Well, Tyson, what are the stealth taxes that are out there that could really blow up your retirement?
Yeah, you think about something like higher capital gains. Most people don't even think about capital gains, but capital gains happen in tax buckets where you don't realize that you're paying taxes on your your savings accounts or your CDs, or in some cases stocks, or on selling at your business. There's all of these different ways that you could have capital gains. There's also estate taxes that people really think, well, estate taxes are for the wealthy. Well, if you don't watch yourself and you've got a house that's worth quite a bit of money, plus you've done a good job saving and putting money away for your retirement accounts, technically going from you and the growth that happens over your retirement life, estate planning or estate taxes could play a role. That's another stealth tax hike that you may not be aware of. Even you think about something like corporate taxes. So many people say tax the rich or tax corporations. Corporations don't pay enough money uh, in taxes because there's all of these corporations that have these ways that they get out of paying taxes. And I, as the little guy, have to pay all the taxes. Well, in reality, what ends up happening with corporate taxes is if corporations have to pay more in taxes, which they do pay a lot in taxes through paying their share of your Social Security and Medicare taxes anyway. But on top of that, if you soak it to these corporations, all that happens is in general, they take these taxes and pass it on to you as the consumer in one way or another. It could be in higher amounts that you pay for goods, or it could be as an employer that you work for them and you don't get as high of a raise because the money is getting funneled to having to pay taxes. And so one way or another, for most people, these are stealth tax hikes that most people have no clue that exist. And as I mentioned a minute ago, I want to drive this point home. You have more control over your retirement tax bill than at any other time in your life. It's just the difference between tax preparation and tax planning. What Ryan, is the difference between tax preparation and tax planning, and why is this so important as you consider what this looks like for rising costs to somebody?
Yeah, well, most people think that tax planning is this, which it's not. They think, oh, hey, here it is, November at the end of the year. What are the extra contributions I can make to my retirement accounts, or what are some charitable contributions that I can do. That's really the extent of most people's tax planning. And then you look at tax preparation. Tax preparation, you either do it by yourself with TurboTax or some online software, or you give to your CPA and your CPA does it. But that's just tax preparation. You're just filling the document saying what happened. We like to expand the definition of tax planning. And tax planning is this: you're not only looking right now at this year and how can you plan to minimize the taxes, but you're also looking 5 years out, 10 years out, 20 years out, even 30 years out in retirement and saying, how can I minimize these taxes? And that's really where it comes into planning. And, I think there's so many services now where you can go get your tax preparation done, but there's not a lot of places where you can go get your tax strategy done. And strategy is one of those areas that it's literally, it could save you tens of thousands, if not hundreds of thousands of dollars in retirement. And it's so crazy to us that people spend so much time on what is the rate of return? What's the investment, investment, investment? In fact, the reason why this happens is because most financial advisors, all they focus on is the investment returns. Well, one of the fastest and safest ways that you could really supercharge your retirement is, imagine if you could minimize your tax bill in retirement by 300,000. Imagine you have $600,000 saved for retirement, and you can save half of that in taxes by having some strategies that not only look at how you're going to take the money out of your IRAs, but it's also going to look at how are you going to take this with your Social Security? How are you going to take this with maybe the pension you have or real estate that you have that produces income? This is where the planning and the strategy comes. And Tyson, one of the things that we've done at B.O.S. Retirement Solutions and Advisors that's unique to us is, as a fiduciary, we think that you really need to be talking about not just your investments, but you need to be talking about the complete picture. It's a comprehensive picture when it comes to your retirement. How are you going to take your Social Security? What are the taxes going to look like on your Social Security? How are you going to take these IRA and 401k withdrawals? What about your Medicare planning? How are you going to plan for that and make sure that it's been optimized? And then how are you going to make sure that when you eventually pass away, that money doesn't go to Uncle Sam, but it goes to your favorite charities or those that you love? And Tyson, this is planning is one of those areas that's shifting. If you're not having conversations with your financial advisor, and now I'm not talking about tax advice here, because you need to get the proper people in to do tax advice. But if you're not having a conversation with your financial advisor about the comprehensive picture, your advisor better understand how taxes are going to impact your $1 million 401k or your $2 million 401k. They better know, or else you probably ought to have a second opinion and start having some conversations, because gone are the days of the 1980s and 90s and early 2000s when your retirement was just about, hey, how much have you saved, and let's manage some investments. And it's got to be comprehensive, because just like society has become more complex, you need to have a complex strategy that is simplified into something that you can understand as you move forward through the next 30 years of your retirement.
That's exactly right, Ryan. So another silent killer that I want to bring up here is inflation. You think about how much inflation has changed over even the last 5-6 years. It's huge. And even if you look at the average inflation growth, what we've looked at is, over time, that purchasing power gets cut so much in your retirement years, because for most people, you think of what you're doing as at a fixed cost. Now at B.O.S. Retirement Solutions and Advisors, we actually create a plan that is indexed to inflation as well, which is one of the great things that we do here. But you think about Social Security cost of living adjustments as an example. Social Security is one of the few things, because pensions, Ryan mentioned pensions mostly have gone away. Some of those were adjusted to inflation. So Social Security is the one thing that most of you are going to have access to that has some kind of cost of living adjustment. So that's awesome. That's amazing. But what ends up happening, what we see time and time again, is those cost of living adjustments don't keep up with inflation. They don't keep up with what true costs of inflation are. And so what ends up happening as well is if you're living mostly off of Social Security, you start having to think about, do I pay for my groceries this week? Do I hold off on my medicine? Do I not get the oil change in my vehicle? Because what we're seeing is even with Social Security, Social Security's lost 20% of its value since 2010. That's a quantified number to show you that even with cost of living adjustments, that it's not keeping up with inflation. With the planning that we do in that income bucket within the B.O.S. retirement blueprint, we look at all your income sources and we say, okay, over time, you're going to need to have inflation as something that is taken into account so that you can turn on another income stream, so that you have more money to continue to buy those groceries, to pay for the medicine, to be able to go take those trips to see the grandkids, whatever it is that you want. Because if you don't, I could tell you 100 stories about somebody who brought in a spreadsheet and said, "Hey, I feel like I've done a pretty good job of really looking at these expenses." And they show me the spreadsheet. And one of the things, there's always a few things that they miss, but one of the things that almost invariably they do miss is adding for inflation, because they don't think about it like we do. We've helped thousands upon thousands of people to retire. And so we've seen all different types of situations, and we have the opportunity to help you to make a real difference in your retirement instead of just crossing your fingers and hoping that you're okay and then getting to be 85 years old, full of life and flat broke. That's not what we want to have happen for you. We want to build this so that we take every single one of these stealth taxes and take care of them for you.
So, Tyson, last night we were having this conversation. I have 4 sons, and age 27 down to 18. And we were having this conversation about what our first mortgage payment was, because our oldest son just bought his first house this year. Our second son, he's looking at buying. And, we're just talking about how crazy it is with how prices have gone up. And so I was telling that, you know, my wife and I, Jenny, we bought our first house, and it was an awesome starter house, finished upstairs, full finished basement, had a great view in a growing area, and we paid $159,000 for that house. And
Did that make them laugh first off?
oh yeah, and the mortgage payment was $900 a month. And I remember 900 a month. I was thinking, holy cow, this is crazy. And they were joking about it because my second and third son, they live together in a townhouse that they rent. It's a nice townhouse, and they both combine their income and pitch in. But that townhouse is $2,300 a month in rent.
Yeah.
And now you look at um, the average price of a home now. It's well in Utah here where we live. It's over $600,000 for a single family home. So inflation, right? I mean, that's in a 30-year time that my wife and I have been married. You go from 159 to 600. You look at where interest rates were higher. Interest rates, I remember, Tyson, you probably remember this. Our interest rate was 8%, and we thought that was pretty good because it came down from over 9%. And so we were like, man, this is sweet. But I still remember that feeling. And what I was telling them is, guys, this is kind of like getting on the freeway when you're going on a on ramp. You kind of have to get up to speed and merge into traffic. But as you get into traffic there, over time, that power of compounding, the $600,000 house that you may be buying right now, there will be a day when it's worth, 1.8 million. And you just have to get in that flow of traffic and make sure that you've got a way to be able to take advantage of inflation, put it working for you instead of working against you.
Yeah. My first house, it was 8.75. I remember sitting around the dinner table with mom and dad and having a real estate agent in our neighborhood who had to end up moving because they weren't selling any real estate because interest rates were well into the double digits, and
Yes.
they were losing their house because they didn't have anybody who could buy or sell a house then. So inflation, it's a huge deal. Now let's move on to healthcare. The average 65-year-old retiree can expect to spend over $165,000 on healthcare, even after Medicare costs are factored in. And if you think that inflation's bad on food prices or even on real estate, it's even worse on healthcare costs. Healthcare costs in general, inflation on healthcare costs have been double digits themselves. And then you think about somebody who, so many people who come in and say, hey, I'm 62 years old. I'd love to retire now. I'm healthy. I want to do some traveling. I want to spend time with my grandkids while I still feel good and do some of those things. And then we say, but have you thought about needing to cover insurance out of pocket until you get to 65?
Mm-hmm.
And they haven't even thought about it. And then we start talking about, okay, now when you get to 65, then a lot of those healthcare costs are still not covered through Medicare. There's still a lot that you've got to cover on yourself. So those are things that you need to consider. And then Ryan, what about long-term care? People, we're not big proponents of going out and getting a long-term care policy necessarily, but why do you need to consider it as part of the plan and how you do your planning?
Well, long-term care, it's really the wild card of retirement because, most people, you don't want to think about, hey, I'm going to need somebody to take care of me. But then there's also this battle where you're like, I don't want to be a burden on my kids. And here's just the reality. There's a 70% chance that you're going to need it. And, the average nursing home costs over $100,000 a year. And some people are like, oh, they now have these home healthcare aides that can help at home. Well, that's still $70,000 a year on average for someone to come in and help. And Tyson, this is hitting home for us right now. Um, you know, here again, you talk about inflation. Our parents built the house that we grew up in for $30,000. And so you think of, I paid basically $160,000 for my first house. Our kids are now paying over 600,000 for their first house. And when you look at this, healthcare, you're likely going to need this. And when you look at these healthcare costs, tomorrow is our dad's 90th birthday. And we love that we have him around. We love his wisdom and we love his humor. I just had him over to our house last Sunday for dinner, and we take turns having dinner together with all of our siblings, and it's just a huge blessing. Well, tomorrow we get to celebrate his 90th birthday, and that's just something that we're super excited about and celebrating him. And they've moved into a place that's really close to us. It's an independent living cottage where they have meals that are brought to them every day, but they're still independent. They still do their own laundry. And our mom's 83, our dad's 90. It's not a cheap place to live. I mean, you look at that place not having any health care in there. That place is about 5,000 a month. And if they were to step up to the next level, that's going to double. So there's your 60,000 becomes 120 at the place that they're living. And that's the longevity it's the ultimate good news, bad news scenario, because the longer you live, it means the more you're going to pay for everything, housing, food, healthcare, and the more likely that you're going to run into, multiple market downturns. You're also going to have inflation cycles that will help boost the value of your assets. But with America's centenarian population growing and projected to quadruple over the next 30 years, we talk about planning to age 100, and you may not live that long, but we like planning to age 100 because we want to see how can you mitigate this risk, which is you don't want to underestimate your lifespan and risk running out of money. You want to overestimate it, and so you can make sure that you've got money that lasts as long as you do.
And so, Ryan, this has been a great discussion around inflation. longevity rates and how much longer people are living that you just talked about, skyrocketing cost of healthcare, and the likelihood of future taxes. These are all things that need to be considered as you get to retirement. And I can just picture you driving, listening to this podcast right now. Yes, you thinking about, man, I feel like I need some more money. And my question back to you would be, would you feel a lot more confident if you had another $100,000 or maybe 200,000 or even $300,000 set aside in your savings for retirement? Believe it or not, growing your nest egg by this much may be an easier proposition than you think. It's not necessarily swinging for the fence or some other risky specific investment strategy. It's by taking advantage of what we talked a little bit about on today's show, which are some simple retirement tax planning strategies. That's right. The less money that you pay to Uncle Sam, the more money you get to spend for you and your family in retirement. And that's why we've put together something just for those listening to today's podcast. We want you to discover how you could dramatically reduce your taxes all through your retirement years with our B.O.S. tax-free retirement savings analysis. We make this really simple. We get some basic information from you. We determine the tax saving strategies that are best suited for your specific situation. And then one of our advisors simply sits down and talks to you about what those strategies look like and help you to see exactly in your situation, customized to you, how much money you could be saving. So if you've saved and set aside at least $300,000, give us a call right now at 800-769-7550. That number again, 800-769-7550. To be clear, we're not talking about some obvious deductions. We're talking about saving you tens of thousands, and in a lot of cases, hundreds of thousands of dollars. As always, we love being able to share this information with you. So give us a call at 800-769-7550. And remember this, retiring successfully today, it doesn't happen by accident. It starts with a plan, and that plan is the B.O.S. Retirement Blueprint. Thanks for listening and have a great week, everybody. We'll talk to you soon.